Alright, so in this video, I wanted to talk about an option selling strategy that can be completely passive or take very little time per week to manage and trade. So the strategy is taking advantage of the expirations on the SPY. So if we go to options here on Yahoo Finance and you look under expiration, you can see that SPY has 3 expirations per week. So for example, July 6th, 7th, and 9th. So if we look at the calendar here quickly, 6 is Tuesday, 7 is Wednesday, and 9th is Friday. Now, 5th is off because of July 4th, but if we look at the following week, we've got July 12, July 14, July 16. So every Monday, Wednesday, Friday, SPY has an expiry. So July 12, 14, 16, and then 19, 21, 23. So every Monday, Wednesday, Friday, there's an expiry. So how can you take advantage of these expiries? So one strategy that I like is selling an out-of-the-money put credit spread on the SPY. So if we look at the chart here, selling an out-of-the-money put credit spread on the SPY every Monday, Wednesday, Friday, but choosing an expiry that is 28 days away. So if we look at the calendar, let's say Monday, let's say we were open on Monday, you would sell an out-of-the-money SPY put credit spread that is 28 days away, so 4 weeks away. So you would sell the August 2nd, which would be considered 20 days away because it's 1, 2, 3, 4 weeks away. And then on Wednesday, you open another put credit spread, 5-point wide, so always the same spread, always the same width of the spread, same amount of contract, and you would sell once again 4 weeks away. So you would sell 1, 2, 3, 4. So the expiry would be August 4th. And then on July 9th, you do the same thing. You sell another SPY put spread, expiry being August 6th. Now, what's the advantage of that? The advantage of that is you're basically just following the market. So whatever the SPY does, if it moves up, you're selling a new put spread. If it moves down, you're selling a new put spread. So yes, if it does fall, then your existing put spread might be in trouble. But that's why you're able to open a new spread, and that new spread has a better chance of winning. That existing put spread now, there's ways to manage it. But that's why you want to use spreads in this, because your loss is capped. Now, what makes this strategy good, let me just give you an example here. Actually, let me show you the probabilities, why I like this strategy. And to show you the probabilities, I will look at the historical data on the SPY. I will download all the data here. So I'm going to click on Max over here, and I'm showing you this from scratch, so you could actually do it yourself with different stocks if you want. It's nothing complicated. So I chose Max daily. I'm going to apply here, and then I'm going to download. It's going to give me a spreadsheet here that I'm going to open, and then I'm just going to manipulate the spreadsheet. Let's say that we open I only have data from 1993. If I choose the SPY, I only have data from 1993. So if I start off with every morning, every Monday, Wednesday, Friday morning, I open a SPY put spread, an out-of-the-money SPY put spread at expected move. So I'm just going to remove the high, the low. I'm going to remove the close, adjust the close. I'm going to remove all that stuff. I'm just going to keep the volume here. Now, I think there's different ways to do this. You could compare from Monday to Monday in 4 weeks, and then Wednesday from Wednesday to in 4 weeks, and then from Friday to Friday in 4 weeks. Or what I could do is just compare from one price 28 days later, another price 28 days later, just to make it even more encompassing. Now, it would be more precise if I go from Monday to Monday, but it's just going to take extra steps. It'll be pretty close if I just take one price and compare it to itself 28 days later. So to do that, I'm just going to pick a price here. So right now we're at sell 2. So if I'm on January 29th, then February 26th is 28 days later. So that's about, because weekends don't count, so that's about 20 cells lower. So I'm going to start off with this. So all I'm going to do is I'm just going to compare the value of the SPY 28 days later to itself. So I'm just going to take this value here divided by the original value. So that gives me how much it moved 28 days later. So as you can see, it moved 0.1%. Now I'm going to remove 1 from the equation. So I'm just going to add parentheses here, -1. So now I've got the percentage. And I'm just going to round it to 2 decimals. I don't need all that extra information. So round it to 2 decimals. So I got 0.01. And now I'm just going to scroll the formula down so that it applies on everything. And I'm just going to make sure if I scroll down just to see the formulas everywhere. Okay. So now this is showing me that if I compare June 26th, and not June 26th, sorry, February 26th to January 21st, SPY was up 1%. And then from March 1st to February 1st, it was up 1%. And then from March 2nd to February 2nd, it was neutral. And then there will be days where it's going to be negative. So if I compare April 5th to, I guess, 28 days before, which I think will be around I think it was 20 points lower, so I think it's around here. So from April 5th to March 8th, it was actually, SPY was down 3%. So now I'm going to take all these values here and I'm going to put it on a different tab just to manipulate. I'm going to paste it. And now I want to see how many times these values occurred. So I'm just going to count. So equals count. I'm going to count this value. All right, so in this column here, I basically used a count if function. So I'm basically counting the number of occurrences that the SPY was 24% higher 28 days later, and then 23% higher 28 days later, and then 8% higher 28 days later. So this column here was a count if function. Counting the number of occurrences, these values came up over here, came up in this column, on this sheet, on this tab. So now, once I did a count if function, I just pasted as values, and then I removed the duplicates so that I'm only left with one value of 24, one value of 23. And then over here I did basically I took B2 divided by the sum. So I'm basically seeing the percentage, how many times percentage wise does this occurrence come up. And then same thing for each cell. So for example, 746 times or 10% of the time, SPY was trading at the exact same value 28 days later. And then on this column here, I'm just basically adding up the percentages cumulatively. So at 68% over here, which is 0, basically all it's saying is that 68% of the time, SPY traded at the same price or higher 28 days later. So I'm basically adding up all these values here. 68, if you look at the bottom here, 68.48. I've got my 68.48. So that's what this is showing. For example, at 3%, you've got an 87% probability. So this means that 87% of the time, SPY did not trade below 3% of its current market price 28 days later. So that's what this means, because 87% of the time, it was either in this range here. It was either no more than 3% lower, 2% lower, 1% lower at the same price, or even higher. And if we go even scroll down, we could see that there were 2 occasions where the SPY was actually 30% lower 28 days later, or 29% lower 28 days later. So that's really crazy, but it's most likely going to be the 2008 and 2020 crash. And in fact, we can go select a few of these crazy negative values here just to see what shows up here. So yeah, you could see that it was definitely in 2020. So March 24th, March 23rd, March 20, when the SPY was trading in the low 250s, low 200s, you can see that it had a period of 28 days where it actually dropped more than 25%. So these are rare occasions, but they do happen, but very rare. All right, so that's what this formula does. It's just to see how many times what happens to the SPY 28 days later most of the time. And you can see that most of the time, 68% of the time, SPY is either did not move or is trading higher than its own market price 28 days later. So that's a good probability. That's a good edge. And even an even better edge is 3% lower, meaning that it does not trade lower than 3% of its current market price 28 days later. So that's where you can come in and do an out of the money put spread. So for example, what this means here is if SPY is trading at 430 and we go find what's 3% lower, so about 97%, so 97 times 430 is 417. So if we sell a put spread, what this means is if we sell a put spread, let's say at 417, 412, it basically means that we have if we go back to the spreadsheet, we have an 87% chance based on data since 1993. There's an 87% chance that this strike here, this 417 strike, or basically there's an 87% chance that a SPY is trading, that the SPY is above 417 28 days later. So SPY will be above 417 28 days later. There's an 87% of chance of that happening. That's all that this means. So if you sell this put spread, collect, I don't know, 60, 70 cents, depending on the VIX, depending on the volatility, well, then you have an 87% chance of winning, of keeping it. So if the stock is at 433 and you ended up selling a 417, 412 put spread, but then the stock, let's say, drops to most of the time, 87% of the time it's going to win. But let's say how to manage it if it doesn't win. If, let's say, the stock drops to, I don't know, 410. So what you could do in that case to reduce your max loss, because your max loss right now, if you collected 70 cents on this put spread, your max loss would be $5 minus 70 cents, the difference. So how can you reduce max loss in case the stock drops? So what you could do is sell a call spread now against it. So if you sell a call spread at a 417 strike, keeping the same width of the spread. So 417 minus 412, we've got 5 points. So 417 plus 5 is 422. So you could sell a 417, 422 call spread, not a put spread, but a call spread. What this does is, since you cannot lose on both sides, right? So if the stock is we've got our short strike here at 417, we've got our long call here at 422, and then we've got our long put, sorry, at 412, 412. So the stock cannot be at different places at the same time. It's either going to be below 417 or it's going to be above 417. So if it's below 417, well, then the put spread loses. If it's above 417, then the call spread loses. But what this does is, let's say you collected 70 cents over here, and I don't know, you collected $1.20 over here from the call spread. So you now have a total of $2.90, or sorry, yeah, $1.90. You've got a total of $1.90. So now your max loss is only the difference, 5 minus $1.90. So your max loss would be $3.10. That's your max loss. And max loss would occur if SPY is either above 422 or below 412, because the price of this iron butterfly, to close it, the max you can close this iron butterfly for is the width of the spread, so $5. So your max loss is $5 minus the $1.90 that you collected in credits. So your max loss is going to be $3.10 in this situation. If you do mitigate the put spread that you open with a call spread. For example, the $1.20 that I'm collecting here will really depend on VIX and how much time is left in the trade. So now if stock actually, let's say stock closes at, I don't know, 415, ends up closing at 415, well then, because the put spread is $2 in the money, or your short strike, your 417 strike is $2 in the money, then your whole spread is going to only be worth $2. So to close it, you're gonna pay $2, but you collected $1.90. So that means your max loss in this case is 10 cents. So that would be one way of managing a put spread that's breached, is by selling a call spread against it to reduce max loss. It does two things. You collect more credit, you reduce max loss, and it gives you a chance, maybe, who knows, the stock comes back up and maybe it lands near your short strike of 417. And you can actually make a profit if it lands exactly at 417. But anywhere between 412 and 422, you can come out of the trade with less of a loss, less of max loss. So here's what this looks like on the chart. So I'm gonna pick a 3-month period, and I don't know, I guess let's just pick this period over here. So let's start off with a Monday. So April 6th, April 7th, April 8th, April 9th, April 12th. So April 12th is a Monday. So let's say we sell a put spread every Monday, Wednesday, Friday, out of the money at expected move put spread. So if SPY is at 411, it opened on Monday at 411. So it all depends what the expected move is, which is hard to tell right now, but it depends on the volatility and the VIX. But as the SPY drops, the expected move will increase because VIX increases, volatility increases, so expected move increases. So your short strike will be further away, making the trade safer, and you'll collect more premium. So let's say SPY opens at 411. I don't know, let's say the expected move on that day was, I don't know, 15 points. So if SPY is at 411 and expected move is 15 points, so my short strike will be at 395. So my put spread will be 395, 390 for 28 days later, which is about May 10th, okay? So remember, I need SPY to be above 395 for me to win on this put spread on May 10th. So let's go to May 10th right away. So you can see May 10th, SPY is trading at 417. So we have a winner. So we'll move on now. Wednesday comes along, SPY is at 413. Expected move is probably going to be around 14. Let's say 13. So my put spread will be 400, 395. That my short strike is 400. So for me to win, SPY needs to stay above 400 by expiry. Expiry will be around May 12, which is 28 days later. So if I go to May 12, I see that SPY is trading at 405. So it came close, but still out of the money by 5 points. So I end up winning on this put spread. We move on. So we did April 12. We did April 12, which was a Monday. April 14. The next one's April 16. April 16 is a Friday. SPY is at 417. It's going up. We're selling a put spread. Let's say expected move this time is, I don't know, 12 points. So we're going to sell a put spread at 405. So my short strike is 405. So I need SPY to be above 405 by expiry of May 14. We go to May 14, SPY is at 416. So another winner. There was a point where SPY was tested. My put spread was tested. But if I didn't do anything and I just held to expiry, this put spread would have been a winner as well. So now we move on. April 16 is a Friday. So we're going to go to April 19, which is a Monday. SPY is at 416. Let's say expected move is, again, 11. So it's going to be another put spread at 405, for example. So we move on to May 17. So May 17, SPY is at 415. So we have another winner. And then we move on again. So April 19, April 21st, SPY is at 416. Oh, sorry, SPY opened at 411. So as you can see, SPY actually dropped compared to the previous day. It opened at 411. So because of that, VIX would have increased a bit. So I'm going to say my expected move is now back to 15 points. So if my expected move is 15 points, my short strike will be 395. So I sell a 395 put spread. And as you can see, if you look at the box up here, it shows you the open, the high, and the low. So you can see that it opened at 411, but the high of the day was 416. So on the same day, SPY moved 5 points. So you probably could have had an opportunity to close the trade on the same day. Maybe not, but your put spread would have been showing profit already in the same day. So if your expiry is 28 days later, so that's about May 19, my short strike is 395 in this case. Now if I go to May 19, my SPY is trading at 410. So we have a winner again. So that's how this strategy would work. This passive way of selling options is selling a put spread on the SPY at expected move every Monday, Wednesday, Friday, and just being disciplined on the schedule. Because sometimes you might be tempted to sell another one as the SPY drops, for example, in the same day. This is something that happened to me back in March. So actually, let's look at March 2020 just to give you, this is like the worst case scenario. Let's see how this strategy would have held up in March. You would have lost money for sure, but March was spectacular. And remember, this is passive. You would have taken a loss in March, but you would have actually quickly started making money again, because as you could see, at around mid-March, your put spreads would have been winners, because 28 days later, you could see that the SPY is back up again. And remember, you don't have to, the SPY doesn't have to be above the price of the SPY the day that you open your put spread. It has to be above your out of the money short strike. Your out of the money short strike is much lower than the current market price, especially when the VIX is high and the market is dropping. So that's what's great about it, is even if you have one put spread that you open that's in trouble, the next one that you're going to open, if the first one's in trouble, that means the SPY dropped. And if the SPY dropped, the next one that you're going to open is going to be a better trade, because the SPY already dropped. It already made some of its downward movement. The VIX went up, so expected move goes up, so your short strike can be further. And the premium collected from your new put spread will be slightly higher. So that's the great thing about this strategy. If you spread out your trades, if you spread out your put spreads, it allows you to just not be in one position all at once. It allows you to really take advantage of the everyday movement of the market. So you're not exposed to one bad move. Now, so let's look at an example. So we need Monday. Where's Monday? February 28th, March 2nd. Okay, so March 2nd is a Monday. So March 2nd, SPY is trading, SPY opens at 298. Now this SPY is dropping, so VIX has increased. So let's say SPY, you might expect, I really don't know what the expected move is, but let's say it's about, I don't know, 15 points for 28 days later. So SPY, so it's about, we're gonna have a put spread at around 285, let's say. So 28 days later is about April or end of March. It's about March 30th. So we need SPY to be above 285 by March 30th. So you can obviously tell that's not the case. So we go to March 30th. SPY is at 261. So this one is a loser. This put spread is a loser, max loss. But you could have, at this point around here, maybe you would have sold a call spread against your put spread to reduce max loss, but you would have definitely lost on this put spread. No way of saving it, unless you rolled it to the future, but you don't know that the SPY would eventually come back up. In this case, you see the SPY crashing. You don't know that it might stay flat for a bit around this point. You don't know that it was going to recover so quickly. So you're just going to stick to the Monday, Wednesday, Friday schedule no matter what. Be mechanical. If your put spread is completely breached and there's 1 week left, maybe sell a call spread just to reduce max loss. Okay, so we did March 2nd. So we're going to move on. We're going to go to March 4th, which is a Wednesday. SPY is back up to 306. So expected move, I don't know, is going to be, let's say, that's the problem. I don't know what the expected move is, but let's just say again, it's 15 points. So my short strike is 290. I've got a put spread at 290. So I need SPY to be above 290 by March 2nd. So April 2nd, sorry. So let's go to April 2nd. April 2nd is here. SPY is at 250. So we have another loser. But that's fine because this is one of the worst scenarios ever. So March 4th, March 6th. So March 6th is a Friday. We sell another put spread. SPY opens at 293. I'm going to say expected move is 20 points. So I'm going to go to 273. My short strike is 273. So I need SPY to be at 273 by April 4th. So I'm going to go to April 4th. It is around here. SPY is at, yeah, it's at 248, 250, 260. So yeah, we have another loser. So 3 losers in a row. But it could be mitigated by a call spread. And as the VIX is dropping, the premiums go up. So that call spread that you're selling to mitigate your breached put spread is going to have a lot of premiums. So you're collecting good premiums from the call spread that you're selling against your breached put spread. So that helps at the same time. So it's like its own self-hedging strategy. So that's why I say it's a pretty good passive income approach to selling options. All right, so now we did March 2nd, 4th, and 6th. So we're going to go March 9th, which is a Monday. SPY opened at 275. So definitely my expected move is higher. So I'm going to say my expected move is about 25 points. So that puts me at a short strike of 250. Now you can see the same day, SPY had a high of 284. So I could have actually closed my put spread the same day for about 50%, 50% profit, if not a little bit more. But let's say I just hold on to it to expire. Even the next day, SPY is at 288. So you definitely, if you have a put spread that you open on this day when SPY was at 275, and then SPY the next day is at 288, you should definitely be able to close it for a good profit and avoid what's coming next. But let's say you did decide to hold for a profit, to hold to expiry, sorry. So I'm at March 9th, expiry will be 28 days later, so April 7th, and my short strike we said is 250. So April 7th, where's the stock at? The SPY is at 274. So there we go, we have a winner. So even in the worst times, you open the trade in one of the worst periods, but you actually end up selling a put spread that ended up being a winner. But obviously you would have had to go through this terrible drop here. If you had sold a call spread in this case to mitigate your put spread, you would have lost on the call spread, but you would have received a lot of credit. But if you had done nothing and just held everything to expiry, this one would have been a winner. So if you had sold a put spread in March 9th in the middle of the worst drops ever, that put spread would have been a winner at 28 days later. So March 9th, March 11th, again, SPY opens at 280. Expected move we're going to say is 20 points, so that puts my short strike at 260. And I need an expiry of April 9th. So let's go to April 9th. SPY is at 278. So there we go, another winner. And then we go to the next day here that we're going to open another one. So March 9th, March 11th, March 13th. March 13th, SPY is at 263. So it dropped a lot. We're going to say expected move. Let's just say it's 30 points. So I'm at 230. Let's just say my short strike is 235. So what is SPY trading at 28 days later? So that'll put me at April 11th. I want to be above 235. April 11th, SPY is around, well, April 9th. I only have April 9th or April 13th. So SPY is around 278, 275. So it's definitely above 235 by a lot. So I've got no problem there. We have another winner. And basically you can definitely see the trend, but all the put spreads coming after here, they're going to be all winners if you just hold to expiry. So you've only had a few losers at the beginning here. And obviously if you opened some in February, they would have been losers if you had held to expiry. So there's another question that comes up is, should you close your trades for 50% profit or should you hold to expiry? So as you can see, sometimes holding to expiry is better. Sometimes closing for 50% saves you from actually getting a losing trade. So it's hard to say what's the correct answer. I think Tasty Trade makes a lot of back testing, and they say closing at 50%, managing your winners at 50% is better in the long run. But that's a decision that you can make based on your own trading experience. But based on what I've shown you, you could see that sometimes holding to expiry ends up being a winner. And if you want a passive approach, this could be a passive approach. Even if you have some max losers, you can see that most of the time, even at the worst, in the worst times ever, the out of the money put spreads holding to expiry end up becoming winners. And as you can see after that, all your out of the money put spreads would be winners after that. So really, it's pretty obvious here. I don't have to go through all of them. So it all depends. So as you can see, now if VIX is higher, our short strike is not gonna be 3% lower. I mean, we've had examples where the SPY was trading, I don't know, at 275, and my short strike was 250. So if my short strike is 250, 250 divided by 275, that puts me 10% lower or 9% lower. So when the market is crashing, when the SPY is dropping, VIX goes up. So if VIX goes up, my expected move is higher. And I end up being at this range here, which shows me I have a 97% chance of winning if I open a put spread with a short strike that's 9% lower 28 days later. Now, of course, these values here are based on all the data since 1993. It's not based on market on March 2020 only. But what I'm saying is your short strike will not always be at 3% lower, but what's great is that it moves with the market. So if market drops, VIX increases, well, your expected move also increases. It goes with the market. It adjusts with the market. Your expected move is going to be further, making your short strike safer. And actually, the scariest spreads are the ones that you open when VIX is low, because your short strike is actually going to be very close. And that's the problem right now with SPY at all-time highs, SPY being at 433. If you open a put spread right now, as I showed you with the at the money straddle, it's showing only 10 points of expected move. So that means my short strike is going to be at 423, which is pretty close. It's scary to have a short strike at 423. That represents 2.4%. I'm only 2.4% lower, so it puts me around here, which is about about 85%, 84% chance of my short strike being out of the money at expiry. So the way I'd get expected move is I basically look at the expiry that I want. So let's say, I don't know, 28 days later, let's say July 30th. I just basically look at the value of the at the money call and the value of the at the money put. So the at the money call is trading for $5, and the at the money put is trading for about $5. So the expected move is $10. So that means my short strike would be 433 minus 10. So my expected move is 423. Now in practice, it's hard to be disciplined, because what I did back in March is that when the SPY was dropping in the same day, another 10 or 20 points in the same day, I was tempted to sell another put spread. I didn't stick to my schedule of Monday, Wednesday, Friday. If I had stuck to my schedule of Monday, Wednesday, Friday, I would have had a better result at the end. But what happened is I ended up opening way too many put spreads just because the SPY dropped 5 or 10 points. But looking back, 5 or 10 points was nothing compared to what happened in March. So it wasn't the best entry. I wasn't giving myself the best entry. I didn't respect my schedule, and I ended up I would sell more contracts than I should have. I was selling 3 contracts. So I ended up losing a lot in March, mostly because I didn't respect my schedule. And also I think because I didn't hold to expiry. Some of them, my put spreads, I ended up losing on the call spread that I used to mitigate. So I had a put spread that I opened at 240. It ended up being a winner at expiry, but because I sold the call spread, I lost on it because of that call spread. Same thing at 260. But that's because the market came back up so quickly. So yeah, so that was my passive approach to selling options, which is a SPY put credit spread every Monday, Wednesday, Friday, 28 days to expiration, and at the expected move, having a short strike at expected move. Now, what's even cooler sometimes is when VIX is super high, you could even, instead of having 28 days, you could probably make it 7 days till expiration, weekly expiries, because the expected move is so high, the 7-week will decay really fast, and you're still somewhat far enough on your short strike. But then, if you just want to stay mechanical, just keep it to 28 days. Make it mechanical, make it as passive as possible. Now, this is not an approach that I'm doing right now, just because I'm being more selective in my underlyings. I'm picking stocks that are actually dropping. It's hard for me to do a put spread on the SPY at 433, but it's definitely something that I would do if I wanted something more passive. And I actually do open put spreads on the SPY or the Qs when they do drop. So I think 2 weeks ago, I had a trade on the SPY that I opened when SPY dropped to 416 after hours, and I closed it for a bit more than 50% profit. All right, so if you have any questions, leave in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend that might be interested in this, and subscribe to the channel. Thanks for watching.